U.S. home prices are in the midst of a major correction. There seems to be some debate over whether this is just a correction or is it a collapse. Or, is it a slow-motion train wreck in which prices keep slowly trending downward for a long time? And as more and more people begin that the housing market is in decline, mortgage applications also decline. After all, who wants to borrow a ton of money for a long time if it is for a depreciating asset? Not all areas are equally affected. But pandemic-era boomtowns and cities that attracted speculators are going to be particularly hard hit. Home builder confidence is collapsing. And mortgage lenders are laying off employees. Zillow, Redfin, and Opendoor and other iBuyers are selling off their real estate portfolios as fast as they can. Prospective buyers are backing away from the market because they think prices have a lot further to fall. And, it seems that this trend is set to continue for a while. What does this mean for the real estate industry? What does this mean for the future of the economy? And, what does it mean for the future of the United States? But, before we get into that, please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Mortgage origination volumes slowed substantially at Wells Fargo in recent weeks. This, of course, is leaving some workers idle. And it is fueling concerns that Wells Fargo will need to cut more employees. The U.S. housing market is continuing its declining trajectory. And the housing slump in the U.S. deepens. Wells Fargo had 18,000 mortgage loans in its retail origination pipeline in October. That is a 90% decline from a year earlier. If you recall, that was when the COVID-19 pandemic-fueled housing boom was in full swing. The U.S. housing market has been on something of a roller coaster ride in recent years. House prices rose dramatically in 2020 because of easy money policies. Add to that the adoption of remote work. And house prices have slowed dramatically this year as the Federal Reserve boosted interest rates. Home buyers have been squeezed. Refinancings have plummeted because borrowing costs surged. Mortgage rates rose more than 7% for a 30-year loan from around 3% a year earlier. And mortgage rates are set to climb further. The Federal Reserve is expected to boost its benchmark rate again today. The situation has stunned home mortgage industry. Rocket Mortgage, for example, has been particularly hard hit. Companies like Rocket Mortgage thrived on loan refinancings. The current mortgage industry condition is expected to lead to consolidation. Many newer non-bank lenders rushed in to serve customers after most U.S. banks backed off from the market. Wells Fargo has historically been the most reliant on home mortgages from among the big U.S. banks. Wells Fargo is looking to shrink the business and focus primarily on serving existing customers, said CEO Charlie Scharf. We have warned investors that the housing market could slow further after saying that mortgage originations fell nearly 60% in the third quarter, Scharf also said. We expect it to remain challenging in the near term, CFO Mike Santomassimo told Wall Street analysts. It's possible that we have a further decline in mortgage banking revenue in the Q4 when originations are seasonally slower, Santomassimo also said. Naturally, Wells Fargo employees are nervous after the bank began laying off employees in April. Wells Fargo has also projected that there will be more layoffs. Local news outlets have reported when Wells Fargo offices have been required to disclose impending job cuts in a municipality, according to a filing with the Securities and Exchange Commission. The ranks of mortgage loan officers, who mainly earn commissions from closing deals, is expected to drop to under 2,000 from more than 4,000 at the start of the year, according to one of the people, the filing also stated. According to sources familiar with the situation, many salespeople have not closed a single loan in recent weeks. Most of the exits have been voluntary as bankers sought other opportunities, said another inside source. Many people are just moving on to greener pastures where they can close deals and make money. So employee departures and staffing levels hard for Wells Fargo to predict. The changes we've recently made are the result of the broader rate environment and consistent with the response of other lenders in the industry, a Wells Fargo spokesman said in a statement. We regularly review and adjust staffing levels to align with market conditions and the needs of our businesses, the spokesman added. Our total workforce shrank by about 14,000 people in Q3, the spokesperson also noted. Shares in Wells Fargo shares are down about 2% since the beginning of 2022. Home prices are now declining in most markets across the United States. But housing prices are still higher than they were at this time last year. Some experts expect a steeper downturn. Other experts say it is unlikely they will fall too steeply. The pronounced rise in mortgage rates over the past several months has basically made housing more expensive for buyers who need a mortgage. As a result, many buyers are pulling back. Sellers are mixed, with some sellers eagerly and systematically lowering their asking price. Still, demand seems to be somewhat strong, and that is supporting prices. There is a sharp turnaround the once red-hot, pandemic-driven housing boom. So the year-over-year differences can appear dramatic. But, as the experts always say, all real estate values are heavily influenced by local economic forces. But markets are clearly cooling off. Certain markets are softening faster or slower than other markets. Markets seeing the largest declines are ones that are the priciest: San Jose, San Francisco, and Seattle. That makes sense because these markets were basically unaffordable to begin with. And with mortgage rates rising, they are becoming even more unaffordable. Among the other markets seeing big declines are the pandemic-fueled boomtowns: Boise, Denver, Salt Lake City, Phoenix, and Las Vegas. People flocked to these comparably more affordable markets when they could work from home. Big price gains seem to be holding up in Florida markets, at least so far. Some big tech companies are calling workers back to Silicon Valley. Other companies seem to be allowing employees to continue to work from home. Many tech workers moved from Silicon Valley to the Sunbelt and Mountain West during the pandemic. Many experts think that it is unlikely that home prices will fall dramatically. That is because there seems to be much more demand than there is supply. Some experts claim that there is still a structural housing shortage in the United States. Leading up to the pandemic, housing supply was low basically because of a decade of underbuilding following the Great Recession. The furious market activity brought on by the pandemic only exacerbated that shortage. House prices rose more than 40% in just 2 years because of the sudden supply imbalance. Some sellers refuse to sell for any amount less than what they believe their house to be worth. Potential buyers and sellers are weighing the effects of inflation, global economic uncertainty, rising mortgage rates, and what seems to be a tight supply of homes. How far and how much prices will pull back? Well, nobody really knows at this point. Home builder sentiment is in a record collapse. There are still a few areas of the US where demand is still higher than supply. But, what do you think? Please press the like button and leave us a comment below. Please hit the subscribe button and hit the bell icon so that you are notified of upcoming videos. Please share this video on social media. Thank you for watching.